So we have big economic updates for you. The world is still on the edge of financial oblivion. Yes, the US GDP and the payroll numbers, they show a strong economy, but the cracks are starting to reveal itself. US commercial real estate is looking like the next shoe to drop, and the damage is already spreading outside of America. And when you have a globally synchronized economy, one crack can quickly evolve into a total collapse. Then we must also talk about China's deflationary risk. It's all over mainstream media and it's the end of China, right? And the collapse is here. But we must analyze it further and dig into the details. Is this true or basically fear mongering? Because if China's in crisis, the entire world is in danger as well. If demand for Chinese goods is slowing, it's emblematic of a global economic slowdown. In our lead story today, Yellen says that commercial property is a big worry as some firms may be stressed. Remember that this comes on the back of Jerome Powell admitting that the US economy is in deep trouble. Now we have Yellen saying that there's a problem here as well. Listen to this, I'm concerned. I believe it's manageable. Although there may be some institutions that are quite stressed by this problem. This is classic Janet Yellen who tried to downplay the situation because this CRE crisis is big and is spreading across the entire financial system. The longer you keep interest rates high, the higher the risk of mortgage lenders going broke. We are at a time when businesses are shunning office spaces and rentals are starting to crash and they are crashing big. In fact, US office vacancy rate increased by 180 basis points to 18.3% in December, and that means 1 in 5 spaces are effectively empty. So there's a glut of supply in the market that's driving prices down. If your landlord, your rental income is declining while your interest payments are going up, especially if you need to refinance this year. Jerome Powell has committed to keeping rates higher until May or June at the very least before he'll even consider any rate cuts. The market is expecting commercial real estate prices to crash even further. 44% believe the big collapse will come in July to December this year, with nearly 30% saying this crisis will drag on further into 2025. And this poses a big problem for landlords. You now have a painful decision to make. Do you roll over your debt at double the interest rate or call it quits and throw the keys back to the bank? Which is it? And if enough landlords they do this, banks will be stuck with a ton of commercial property. And to raise liquidity, they'll be forced to sell these buildings in a market that's already falling. And this will drive down prices even further and crash their balance sheet. The real crisis for banks now, as we said many months before, is still commercial real estate. As of last year, banks hold almost 40% of US commercial property debt, and that's over $1.7 trillion of exposure spread across Wall Street. It's an enormous risk that gets closer to exploding the longer interest rates stay high, which makes the next few months until June really volatile. If Powell decides to delay the hikes or just cut once or twice this year, that's it. We could see the banks and mortgage lenders just throw in the towel. The New York Community Bank collapse is just one example of this collateral damage getting out of hand. The share price for the bank has collapsed by over 50% in a single week. That dragged down the entire regional bank index as well. The regional banking crisis isn't over, and it all has to do with real estate now. The US Treasury bond collapse has been solved with the Fed's crazy bank term funding program, the BTFP, we all know that. And going forward, we could actually see Yellen and Powell backstop a real estate collapse as well. Moody's has downgraded the bank to junk status, and this tells us that NYCB is in trouble and could default on their bonds. So invest at your own risk, you might actually be catching a falling knife. And if we dig into the bank's loan book, their biggest exposure is in multi-family property, corporate loans, and commercial real estate. Over 60% comes from real estate, which kind of exposes the big problem in the US today. It's all about over leverage and real estate loans. The problem here is the contagion effect. Earlier this week, we heard that a Japanese bank was crashing because of exposure to US property. This crisis is now spreading all the way to the Eurozone, to Europe as well. From Bloomberg, US commercial real estate contagion is now moving to Europe. A German bank with property exposure in the US is now taking a brutal hit. Their bonds are collapsing in value. Property exposed AT1 bonds have plunged in value. The biggest hit comes from the bond with an 8.5% yield. That bond has crashed from 70 cents on the euro to 40 cents. That's a collapse of over 40%. Remember, guys, these are the same type of bonds that Credit Suisse issued and defaulted on. AT1 bonds are perpetual bonds that can't be redeemed by investors. Technically, they pay interest coupons forever, but that is a moot point if the bonds gets defaulted on. So the debt linked to commercial real estate is plunging in value because the contagion risk is getting very real. If US CRE collapses, all these bonds could default or the bank could redeem them back at pennies on the dollar. So investors, they are now dumping these perpetual bonds on the open market. Getting back 40 cents on the dollar is kind of better than nothing. And if we zoom out to the other European banks, we can see a big problem that's truly brewing. A real bank has a crazy US CRE exposure of 8.6 billion euros. That's equivalent to 16% of their total assets. That is insane. That's a gigantic exposure that could cause insolvency if things get bad enough. Even Deutsche Bank has a 17 billion euro exposure to US real estate, which should tell you how far this contagion has spread. That's just in Germany alone. Local US banks are also at risk. According to JP Morgan, nearly 29% of assets at small banks are commercial real estate loans. The value of these loans are at extreme risk because commercial property values are dropping. The crash is hitting close to 30% for office buildings. We have no idea how much leverage is in the system until the shoe drops. This is a big time bomb that we can't ignore, guys. Anything could go wrong in 2024, especially when the Federal Reserve is delaying the rate cuts. And speaking of bonds collapsing, Argentina's debt is also in trouble. Whatever Javier Milei is doing is facing huge resistance in the country, and as a result, investors they are pulling their money out. In a shocking update, Milei shock therapy is suffering a rejection. Congress is rebuking his bill and tearing up his agenda, and as a result, investors are running away, causing Argentine bonds to crash in value. Remember, the whole idea of investing in Argentina revolves around opening up the economy. Milei wants to privatize everything, and as a foreign investor, this sounds like a great idea if you're chasing returns. And because of this, Milei lost his cool and he went crazy. His office did a name and shame by sending out a list of 61 legislators who voted against his bill. These are the people who voted against the people, as he calls it. And this is bad because passing any new law is now going to get tougher and tougher. Milei doesn't have much time to turn the Argentine economy around. His IMF money is going to run out sooner or later, and inflation in the country has reached legendary levels. Argentina's inflation is expected to soar to 250% this year, which in itself is a terrible crisis. The higher inflation is, the more the Argentine peso will get dumped for dollars, and this will drive up more demand for USD and cause Argentina to issue more bonds to get the reserve currency. It kind of triggers a deadly cycle of endless borrowing, and that increases the supply of debt and makes it more likely for the country to default again. And it's not the first time Argentina didn't pay back their bondholders, so it's no surprise that Argentine bonds are collapsing today. Their dollar bonds have crashed, dropping by nearly 2%. It's the biggest drop since Milei took office. Remember, guys, this drop affects more than just this specific bond. Future debt issuance will have to offer a higher yield to get investors back in. Any gambler looking to buy Argentina debt will demand a higher return to take on this insane risk. It's simply how the market works, right? Supply and demand, risk and reward. And if this chaos continues, Milei likely needs another loan from the IMF once again. And here's why. The provinces in Argentina, they are going broke. Foreign investors have a lot of money invested in these provincial bonds, over $14 billion worth. For the US equivalent, it's like investing in a bond from Florida or Texas. Many provinces in Argentina are heavily reliant on discretionary transfers from the central government. And this is basically additional money states are getting to run the region. La Roja, for example, takes 13% of their total income from the government. Milei's austerity cuts threatens to cut away their income, which pushes these local bonds closer and closer towards eventual default. Two provinces alone have to cough up $800 million in payments this year. And if that is under threat, Milei has no choice but to backstop it by issuing more government bonds to plug the hole. It's boring from Peter to pay Paul, but there's not much choice left, so the Argentine situation isn't looking very good here. And this brings us back to the big panic surrounding China's economy. And we must talk about that. If we look at all the headlines out there, things in China seems irreparable and the collapse is coming tomorrow. I think it's already here, right? According to the headlines. So we need to cleave through the noise and understand how bad this crisis is. Is China truly uninvestable or is this an opportunity? Let's go through the doom and gloom first. China's deflation will continue to last at least the first half of 2024. Consumer price growth should end the year at 1%, which means 1% inflation. Now, for many of us, 1% inflation sounds like a dream come true. It means prices are going down and our money can effectively buy more. But because we are in an economy that needs things to constantly expand, there's a big fear that deflation will crash everything. Firstly, deflation is nothing new in China. Producer and consumer prices went negative during the big economic crisis. It happened during the dot-com collapse, the '08 crisis, and in 2020 as well. Prices in China has slipped into negative territory since Q3 last year. It is easy to understand why. China's deflation shouldn't come as a surprise, especially since they are the world's factory. Global imports are dropping, countries are buying less stuff from Beijing and around the world in general. And when demand drops enough, prices can't possibly rise. Prices go down. And does this mean the country is going to collapse? Will all Chinese stocks crash to zero? China's is done, right? Let's dig a little into the numbers and you realize that that probably isn't the case. Putting up China's CPI chart, we can see a wonderful breakdown of the deflation. CPI deflation started in July, which means prices started to fall back then. Two things are crashing in price contributing to the deflation report. The first is in black, which is food, and that makes up 31% of the CPI number, so it is a big factor. Food prices are coming down, so people in China are spending less compared to the rest of the world. That isn't a tragedy. In fact, it's good news for people's spending power. The less you spend on food, the more you can save or spend elsewhere. The next biggest contributor is transport and communications, which is in yellow. And this contributes 13% to the CPI print, so it's still very significant. Deflation here simply means fuel prices are getting cheaper. Your phone bill is also getting cheaper. Prices at the pump in China, they are going down. Once again, this is no surprise because Beijing has been importing a ton of cheap fuel from Russia. There's a commodity glut in China right now which is pushing prices down. Apart from these two categories, everything else in China is still inflating up. And because of this commodity glut, manufacturing is the main culprit of China's deflationary pressure. And going forward, manufacturers will continue cutting prices to shed all this excess supply. It means exporting deflation to the world, which is a good thing, but profits will be down for Chinese companies for quite a while. But I want us to look at this from another lens. We are seeing the Chinese economy bottom out. When the economy turns and demand starts to pick back up, this state of deflation will normalize back into inflation. But China will have a lower cost of production versus other parts of the world, so record profits won't be far behind. But if you're investing in China, you need to understand this deflation phase. China's economy is heavily dependent on global demand. The transition to domestic consumption will take many more years. It's not going to be an overnight affair. I expect Chinese stocks to be stuck in limbo until things turn around. A good time to accumulate, but don't expect any meaningful gains this year. But zooming out, China's deflation does tell us that the global demand is suffering. It's a signal that the world economy is weak right now. It's a much clearer sign that all the US GDP or payrolls report, right? We all know how genuine those are. So be prepared. Not only is the underlying economy weakening, but there's also a big CRE crisis back in the US, and that could implode the banks the longer rates continue to stay high. But let me know what you think. Will US real estate cause the next recession again? And how long will it take for China to recover? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.